Okay, so welcome back. So this panel, we're going to have Devin Thorpe. I'm going to introduce Devin, and Devin will introduce the panelists. But Devin, in his bio, says he sees himself as a social innovator, but we see him as a social innovator. And we're going to hear about the next stages and the developments in the capital formation playbook. Go ahead, Devin.
Thank you so much. I'm really honored to be here, and really thank you for all being here. I want to, as the co-chair of the CfPA, I want to join my colleagues in thanking the sponsors. I know the sponsors are really what make this event possible. I know those of you who bought tickets might have felt like you contributed a lot. You did. We're grateful for that, but we really could not do this without our sponsors. So, and thank you. I think all of our panelists today are sponsors, so thank you guys. I want to introduce our panelists in this order. Meighan is an extraordinary human being. She is she's the chief legal officer at Dealmaker, one of our platinum sponsors. Which is of course a leading platform, very tech savvy, marketing savvy, and really, I don't think there's a platform with a larger average raise size than Dealmaker. It's a phenomenal platform. She's a seasoned attorney licensed both in the U.S. and Canada. She has over 20 years of experience, which I find amazing given that she's 14 now. And she has worked both in securities, corporate law, and IP law, and has worked at McCarthy, Tetro, and Spear Woodward, as well as in her current capacity at Dealmaker. Marty Tate, well, let's see, Craig Denlinger is the managing partner at Artesian CfPA, and he does a tremendous job. He serves on the board of the Crowdfunding Professional Association, and his firm is a leading auditing and accounting firm in the crowdfunding Jobs Act world. He's kind of specializing in those Reg A and Reg CF offerings. He's, of course, a certified public accountant. He's recognized nationally as an expert in crowdfunding finance, SEC reporting, and startup financial strategy. And Marty Tate is an old friend of mine from my Utah days, and we're glad to have Marty here. He's a partner at Kunzler and Adamson. He specializes in corporate finance securities, fintech, blockchain, and crowdfunding law with over 25 years of experience. He represents leading funding portals, broker-dealers, and service providers and issuers nationwide on Reg D, Reg A, and Reg CF offerings, and serves as the Chief Legal Officer for Core Inc. So we have really an expert panel, and we'll give you some time to ask some questions before we're done today. But I want to start with a question for all of you, and maybe invite you just to go through the roster as you're sitting on the panel. But with the change in administration, change in regulatory leadership, the SEC, it's easy to anticipate some changes. What are you expecting to see from a regulatory change standpoint? I know, Meighan, you've been working on the Hill. What are you seeing?
Yeah, this is not going to sound like a surprise to most people in this room, and we're going to hear about it later today. But there is pending market structure legislation on the crypto side of things that we expect will be passed this year or early next year. There's a House version called the Clarity Act. There's a Senate version called RIFIA. And the results of that passage will have profounding effects for the capital formation industry across the board, not just crypto. What is refreshing to see, though, is that some of the old rules that have really tied down entrepreneurs and capital formation are getting a lot of attention right now. They need to be changed as well so that things like digital assets can work better in the system. So whether you're working with digital assets or not, I expect to see some changes as a result of those bills moving through the system now.
Yeah, in addition to what you said, I with every administration change, we obviously can expect changes. Some of these changes have been bigger, more ambitious than other changes. I was telling a colleague that I was excited to come to this because I am excited to hear kind of maybe some direction, and one of the things is that, and just get a little bit more clarity, not no pun intended about the clarity, but just clarity on exactly what it is, because there's been a lot of talk about this happened. We've had clients call and say, it will, well, now through law, we can do this, we can do that. Well, we still need things to pass. We still need regulations. We still need some more direction in exactly what is it. And I'm trying to tell my clients, we still need to follow the law is still the law. We still need to continue down this path. Hopefully some changes will take place. We'll have more direction, more clarity, and understand exactly what we can do. And I keep reminding people that I've had a few clients that said, hey, well, we think we can that doesn't apply to us anymore. We can just kind of do whatever. I said, well, I wouldn't go so far. And administrations can change, and you never know what will happen in the future. So anyway, that's my thoughts.
Greg, do you want to add anything? I don't want to leave you out.
I sit on the policy committee with Meighan, so I just defer to her expertise as well.
Okay. Fantastic. Meighan, as a quick follow-up, you have been coordinating the activities, really leading them on behalf of the CfPA. We had some great meetings yesterday that you led. I'm grateful for that. Really interesting to see the progress. But at the same time, we were doing this in the middle of a shutdown. The members were all gone. It begs a question, right? I think 6 months ago, 9 months ago, we expected big changes. Are we going to see changes? Are we? What is your take on just the mode and how Congress is going to operate? With all the control sort of in the hands of one party, look like this is going to just roll through a bunch of changes. What do you expect?
Yeah. So, we at the CfPA kind of been working on anticipating a lot of changes this year because of the change in administration. So it's been a group effort. Yesterday was still a great day, even without members on the Hill. And history of what the last years looked like and how it was different yesterday because of the current shutdown. When we were here meeting with staffers and legislators, we heard the same message. And that was, we can't really do anything right now. It's kind of a dead Congress. Can't get anything passed. And so there was interest in speaking about issues that were important to entrepreneurs and small businesses, but there was a recognition that little was going to actually happen given the current state of the government at the time. And obviously that changed, and there was this really renewed optimism that things, as Devin implied, really fast across the board, and that included capital formation. And that did happen. What you saw on the capital formation side, the House Financial Services Committee, which is a very influential committee in Congress, is led by Chairman French Hill. He's spoken at a lot of events across the board. He was very aggressive about making sure that bills that had been sitting dead for many months, up to 18 months, actually got pushed through as quickly as possible. So he's been working with Congresswoman Wagner, who is the chair of the subcommittee on capital markets, and they've been working to push through between 14 to 28 bills that were just sitting dead from the last administration. Ideally, they're trying to push those through by the end of the year. So the first message I think to take away from this is on the capital formation side, which impacts all of us in this room, we have a really great group of legislators who are very passionate about making progress, pushing through progress, and doing what they can while the House and the Senate are both controlled by the same party, because it's just much easier to push through legislation, no matter which side of the political aisle you sit on, when it's one party in charge of both houses. So that's a great thing from the industry perspective. In terms of the shutdown, there is going to be a delay. We had a bunch of meetings yesterday that Jenny and have mentioned. Bills that have already gone through approval by a committee or approval by the House will most likely still get pushed through this year and end up in a package for President Trump to sign. If the bill hasn't gone through either of those processes yet, it's very unlikely that it will be pushed through this year, and it will be pushed to first quarter next year, which means, of course, there'll be a backlog next year. And there's really going to be a fight for attention next year in terms of which old bills and which new bills actually get attention in the first 6 months of the year, because then attention will pivot to the midterms. If you're thinking about wanting to go and meet with congressmen and women on the Hill and staffers, think about what issues really important to you and how that impacts the broader industry, because there is going to be an opportunity for one or two issues to get some attention next year that haven't already gotten attention, but not 10. That would be the message that I'd leave people with.
Excellent. Craig, you deal with the accounting side, right, of your firm. And the reality is accounting is really, I think, way underappreciated by entrepreneurs. They see it more as a burden than as a strategy. And so I anticipate you see a lot of problems that you go, both from the standpoint of what your clients are doing or not doing, and the regulatory challenges they face as a result. How do you see that situation? What are the challenges they're facing? What are you hoping for in terms of policy changes to adapt to that?
Yeah, piggybacking off what Chris said earlier about the issuers in Reg A and Reg CF being further along, that's the number one thing I'm seeing. Same problems that we've been dealing with all along in this world, but everything's getting more advanced and more complicated when we got companies coming to us with 20 revenues versus those first few or very little revenue type of companies. That makes for a much more difficult getting everything cleaned up and caught up. That it's just a very complex process of bringing things from cash basis QuickBooks to SEC rules, especially on the Reg A side. There's a lot that goes into that, and that's all being balanced with the zillion questions that the entrepreneurs are being asked of the lawyers, the portals, brokers, and various other steps along the way. A new thing we saw first time this year was one of our early Reg A clients crossed a $50 million threshold that forced them to full public company reporting. That was something that was kind of a wait and see for many years, and this is the first time we've seen that tripped up, and still working through that process with them. But it's a very big deal to move to full public company reporting, and I think at the stage we're in as an industry, that's going to be kind of a good problem to have. You're hitting 50 million revenues, you're probably pretty happy with things, but it's also a huge process and an ongoing huge time and financial burden for companies.
Do you think it would make sense to reduce that public reporting burden for those sorts of reporting companies to semi-annual? Would that make sense to you as a CPA?
They have thresholds for what you need to do and when. It's quarterly right now for the full public reporting, and for the smaller ones, I certainly don't think that'd be a problem, and especially when they're not trading, which my client is not planning to be. So, timeliness of information is as important. For a private company like this that's not trading, it's really not any benefit to anyone to be going through this. So, be a beautiful change to carve out some more exemption there, maybe increase the cap on that revenue to something that's not as easy to trigger for us.
Yeah, inflation has made that less meaningful of a threshold.
Other things, the accounting standards setters are always slow to react. We got finally crypto valuation guidance. That was something we wrestled with for years and years. There's a number of other things that have been out for a long time that remain unaddressed, like safes and like royalty-based or revenue-based debt structures, things. We tend to see all the complex stuff first in this industry, and then it's smelling like we're going to be waiting 10 years for rules and guidance on a lot of that stuff as it comes up. And I'll finish with my wish list for change. The accounting and auditing rules are a lot easier on the Reg CF side than Reg A. So a lot of companies go to Reg A that otherwise wouldn't need to if we had a higher Reg CF threshold. So I know with the various bills being pushed through, that's something on the table. If that got increased from 5 million to 20, 50, or a bunch of different numbers thrown out there, but that would be a good thing for the industry from our side of things, that make things a lot lower cost and more timely for issuers working with the Reg CF rules.
That's great. Great feedback, Craig. Thank you very, very much. Marty, I'm curious, you work with all the different players in the industry. So you've got this great perspective, and I imagine you're seeing some real innovation. Tell us about what some of you're seeing that's innovative, new kind of in this marketplace, and where you see the kind of the puck heading.
Yeah, so you're seeing a lot of the innovation. So it's kind of approach it from the Reg A side and the Reg CF side. On the Reg A side, and it's not a new innovation, but what is new is how it's being used. But the use of a series LLC, that was sort of first introduced, I don't know, 5, maybe 6, 7 years ago. in with collectibles. That's where we really saw the use of a series LLC. So you could have a car, a racehorse, a pair of shoes, whatever it was. We worked with spirits companies and wine companies and different collectibles art in an individual series. Now that's expanded. So now you're seeing real estate. We worked with one of the first real estate companies that used the series LLC. That was a heavy lift with the SEC getting through that process. Now companies like Arrived are doing that regularly. And so the use of the series LLC has been, like I said, it's expanded a lot. We've seen some innovation on the Reg A side also, just with companies that would be qualified as an investment company are typically prohibited from using Reg A unless there is a sort of an exemption from that. But we've seen some creativity with how a Reg A is used to basically do investment type structures. So investing into a Reg A company that then goes out and does microloans and so forth. On the Reg CF side, you're seeing a lot of creativity. You're seeing, typically, initially, it was a lot of equity offerings. Use of a safe probably has been the largest security that's been offered there. But now you're seeing things like bonds, seeing things like revenue sharing, where you just are working with a crowdfunding portal that's going through the FINRA process, that is going to be doing revenue sharing on video games and apps and so forth. So that's pretty unique. And then within Reg CF, you're seeing some creativity with even having offerings with multiple sort of offerings within that offering, so that so the investor has a choice of, yeah, I want these terms or these terms or these terms. And one of them had up to 16 different terms that they were offering. The other thing, the last thing that I'll mention is we worked with a company that was using Reg CF and Reg A to provide equity to their members. So they were a membership club that was, I want to say similar to Amazon. Nobody's similar to Amazon, but you get the point. They were an online retailer that was, and they wanted to reward their members with equity in the company. So they used Reg A and Reg CF to allow people, you'd buy a membership and you'd get equity in the company. That's what they did on the Reg A side. On the Reg CF side, you would buy equity in the company, you'd get a membership. So they used both of those to basically give away equity in a company, which I felt was unique. And again, they're still in the process of doing that capital raise, but it was a pretty unique and innovative structure.
Yeah, that's there really are a lot of innovations coming down the pipe. I'm really excited about the app and video game platform. There's one doing something similar with YouTube creators, and so there really are some cool things going on in the Reg CF world. And I appreciate you sharing just a taste. Meighan, let's come back to you. You know, I mentioned that you and your colleagues at Dealmaker, I think you have the highest average Reg CF raise, certainly the highest average raise among all the offerings you're doing. Big raises, which is great. Very cool. Are you starting to see institutions play along and participate as investors? Is some sort of a playbook beginning to form for institutional participation or not?
I don't know if I would go so far as to call it a playbook, but certainly the tides have changed. So if you look out even a couple of years ago, or potentially less, Reg CF in particular was kind of seen as a last resort. You couldn't get VC funding or institutional funding. Now it can actually be seen as an asset if you structure that Reg CF around community and you're able to show sort of proof of concept. It validates the business. We're going to hear a little bit about how to establish that community from a marketing perspective later. We've got a whole panel on that. So that strategizing around building your community and how you do that is a really core component if you're going to try and combine Reg CF with institutional funding. What I would say is that if that is something that you're seeking to do, planning is really key. You know, finding some good advisors like the gentleman here next to me, lawyers and accountants who can really walk you through the steps that you need to think about. For example, a lot of our issuers will spend a lot of time thinking about what their cap table looks like. You want it to be appealing. Using an SPV is one of the primary ways that typically we see issuers use to control their cap table. Thinking about how you're going to value your capital, valuation is really important. And then, also just thinking about how you track your metrics. How are you going to show that proof of concept? What do you need to bring that institutional capital in the door?
Excellent. Craig, I want to come back to you. Marty was talking about some of the innovation he's seeing. You obviously are coming at this from a very different vantage point, both geographically and professionally. What are the innovations you're seeing from your days?
The big thing with our client base was the Series LLC, as Marty touched on there. Likewise, 6-7 years ago, people like Chris Ransom over here with the racehorses, lots of real estate, collectibles, variety of things have rolled through that for years, and still getting new types popping up on my desk over the past couple of years when NIL deals for college athletes started becoming a thing the past couple of years. Of course, that pops in is a couple different clients working on Series LC structures to allow those student athletes to kind of early cash out on their potential future earnings. Pro athlete contracts have also been going through the Series LC structure. Music royalties, we've had a few over the years. We've got a couple new ones coming through that seem to be getting a lot of traction. So that's just been really cool to see a lot of unique, cool things that people can invest in if these things take hold.
This is really cool. Such a fun conversation. Marty, I want to come back to you. How are the fintech innovations altering the landscape? What do founders, investors, and other practitioners need to do to adapt, to take full advantage? I mean, there's a whole room full of people who want to know, really, what are the action items that they should be taking?
Yeah, so, and I think we have a whole panel later on, so I don't want to steal too much of their thunder on the fintech and crypto side. But I think that one of the things that we're seeing, and this isn't new, but I think there's sort of a renewed excitement about it, is when people are coming and saying, hey, we want to do this offering and we want to tokenize it, which is really just a technology. It's still going to be a crowdfunding offering. It's still going to be a securities offering. It's just how are those, for the most part, I guess, it's how are those securities, how are they going to be registered? How are they going to be tracked? Is it going to be done just on a traditional ledger, or are you going to move that to blockchain where, and you're seeing major exchanges moving towards the tokenization of their securities. You're seeing other companies that are and players in this field that are looking to adopt the tokenization of digital assets as part of their protocol. So I think that that's something that when you're asking about what can people do, I think it's just having that eye towards that future and answering those questions maybe sooner rather than later. Instead of down the road where you think, okay, hey, we're already a mature company, now to move towards that. That would be my thoughts.
Great insights. Well, I've got about 72 more questions for this group, but I want to give you all an opportunity to ask questions. What do you want to know from this super panel? You got any questions for them? Okay, in the back.
Absolutely. Hey, good morning. Thank you so much for your insights. What are you seeing on the international investor side as far as Reg A is concerned? Is it as limited from a taxation standpoint as well as from a regulatory standpoint? Are you seeing some innovation happen there, policy-wise?
I'll take a quick swing and then I'll pass around. But so with regards to Reg A, international investors can invest in a Reg A. A lot of times people think that you need to do a Reg S or something. But you did hit a good point, is that sort of taxation, depending on the structure of how they're investing. So if they're investing in something and it is something like a Series LLC, then there could be potential tax consequences based upon that structure. But if it's set up as something like a REIT or a corporation, then they don't necessarily, unless they're paying dividends, they wouldn't have to pay U.S. taxes. So that's just something to think about. So structures to get around that. I haven't seen a lot of creativity at least in the Reg A space, about that. That's just something that, if you want to invest in those deals, you're going to have to, you potentially will have to pay taxes on it. We do a lot in the fund space, and so there's a lot of, blockers and so forth that can be put in place. But I really haven't seen that put in place in crowdfunding. Want to weigh in on that?
Thanks, Marty. I have a great question. Thank you very much. DW, you got a question for us? Thanks. Appreciate that, Elizabeth.
DW Farrell with localfund.org. And my question would go back in history a little bit. 100 years ago, we had something called curve exchanges that matured, and bucket houses, which was leverage investment, which was shut down. There's been, especially in certain, I'll say, quality markets, leverage investing or speculative investing where there was no underlying cash, essentially getting a loan to put money in. How do you see things going forward? Is that going to, I have my own opinion about whether or not that's good for the market, but how do you see that going forward, especially as regulation pushes to deregulate? Great question. Meighan, do you want to jump in on that?
Yeah, we're not seeing a lot of that in the space that we work in specifically. I think where you're seeing a little bit of hedging that's similar to what you're describing, but not exactly the same thing, is certainly on that tokenization side of things, where you're really seeing tokens that in some cases represent underlying value and in some cases don't. So that's where we're seeing a lot of chit chatter in the market. And to the point that Marty made, it's not quite clear yet whether or not some of those things are going to be treated as securities or not. There's certainly a gray area there, and lots of people on both sides of that argument. So that is one area where we're seeing a lot of chit chatter.
Okay, great question, DW. Mezzi, I think you had a question, didn't you? Thanks, Elizabeth.
Thank you, Devin. Meseret, running crowdfunding from Africa, Ethiopia. So I wanted to ask you the reverse. You just answered the question, international investors investing in the issuers here. But how about the reverse, people investing on international issuers? Is there any even movement? Meighan, especially yesterday, we were running around the capital, if there is even any movement in terms of regulation, but what your take looks like on the reverse side of it.
So I'm not going to dare speak to international crowdfunding rules. I know that certain countries have approached that. What I will speak to is the use of U.S. crowdfunding to fund things that are not within the U.S., so international projects. Regulation CF is limited to U.S. issuers. Regulation A is limited to U.S. and Canadian issuers. We did do work on a Reg A that was a U.S. company that was providing microloans to companies in Africa. So that was something that was again, U.S. entity, U.S. funding, but was actually benefiting projects that were outside the U.S. So again, that speaks to sort of that creativity of being able to use Reg A. But I'm not sure if that answers your question or just creates more questions. I don't know. But anybody else want to weigh in on that? Okay.
Excellent. We have time for probably one more question, if someone has a question. Okay. Okay. Oh, here. Yeah. You're getting your workout, Elizabeth. Thank you.
I'm Chris Ransom with my Racehorse Syndicate horses. Are you guys seeing some creativity in the use of revenue contracts, which seem to be kind of taking place, both from the Reg A space and the Reg CF, which generally I think were kind of a challenge in the prior administration, but seem to be possibly popping up? Is that something that you are seeing more of in the space?
So I have seen that. So I mentioned before that we're working with a app development gaming company that's using revenue sharing. Interesting, we just spoke with a precious metals company, and the idea for that, it's similar to almost like a futures contract, so we've got to think about that because there are prohibitions on that, but what they want to do is basically they're trying to not only fractionalize and securitize these mines, but they're wanting to tokenize it. So there's all of these things, but that would be based upon a revenue. So rather than it be owning the actual mine, it would be you're buying an investment contract that would title you to rights, see future revenue of that. So yes, we're seeing stuff like that, but it'll be interesting to see how the SEC approaches it. I know during the past, in the previous administration, and again, these go up and down, but initially, even with digital assets, there was a lot of pushback, then there was more of an acceptance. It'll be interesting to see what is allowed. A lot of times it's also just the luck of the draw, what examiner you get. Some people have their pet issues and they just won't let you get it through. So those are my thoughts.
Yeah, and we are seeing a lot of revenue deals going on in the Reg CF space now. It's really quite common. I've invested in some myself. We've started doing them deliberately about 2 years ago, and Honeycomb started doing them a year ago or so, and so it's becoming a thing for sure. I think it's a great trend. I want to thank this great panel. Oh my gosh, what a tremendous roster of people. Please give them a big hand. I mean, these guys are great. Thank you all. And thank you, Vince.